Welcome to Module 2 of the FX Pro Trader Program. My name's Carl Woodhouse. I'm head trader and co-founder here at Trade Simple, Trade Smart. And first and foremost, I'd like to congratulate you on the completion of Module 1. So in this section, we're going to look at how and why smart money manipulate the Forex market. We're then going to look at the 3 stages of market manipulation. We're then going to go on to look at how to identify the smart money daily and weekly cycle. We're going to take an in-depth look at stop runs and why your stop loss and pending orders are so important to smart money. And in terms of stop runs, stop losses and pending orders, these are some of the most important factors when it comes to the banks manipulating the markets. From there, we're going to look at confluence and high probability manipulation areas. We're going to look at how to identify a stop run and enter a trade using candlesticks and candlestick formations. And finally, we're going to take a look at stop loss and exit strategies that we can apply to trades once we have entered them. But before we go on to look at how and why the banks manipulate the Forex market, I want to discuss something that goes hand in hand in understanding not only the objectives of the banks, but also the Forex market in general, and that is retail trading and retail education. Okay, so it is said that around 95% of retail traders are consistently on the losing side of the Forex market, and will generally have their account wiped out within 6 months. Okay, so it is said that around 95% of retail traders are consistently on the losing side of the Forex market and will generally have their account wiped out within 6 months. Now, for those of you that are new to trading and trading education, that is a shocking statistic. Okay, now for those of you like myself who have been around not only trading but also trading education, this is something that is not only true, but we can all tell you stories of friends, families, even companies that you may have worked for that have had a go at trading the Forex market and have failed within 6 months or less. Okay, now there is a reason for this. Okay, and this is because 95% of retail traders are taught the same strategies and techniques for trading the Forex market. Okay, so the two go hand in hand. The failure of retail traders and also the education of retail traders go hand in hand. Now, something I want you to think about is the world market and the banks, the institutions, and all the other participants are some of the biggest, most powerful, most liquid firms in the world. Now, not only do these market participants have access to vast amounts of capital, but they're also able to attract and employ some of the brightest individuals that walk the earth. Now, these are your opponents. Okay, so you're taking on the biggest and the baddest in a sense. So with retail traders, the general belief is you can take a course over the course of 2 to 5 days and you can learn about trading indicators, you can learn about oscillators, you can learn about Fibonacci, you can learn about support and resistance, and then you can walk away, open an account and become a successful trader. Now, in any other industry in the world, you wouldn't even attempt or entertain the process. Okay, so if I was to tell you, for example, that you could go to a hotel room somewhere and you can take a 2-day course in medicine, and this will give you the qualification to go and open your own general practitioner surgery, would you even entertain the idea? Okay, now common sense says no, but yet with trading and the world of trading, there is a belief that a 2 to 5 day course can equip you with the skills necessary to take on the biggest firms in the world. Now, just think about that for a second. And then slowly but surely, the 95% failure rate of retail traders quickly makes sense. Okay. With retail trading, not only does the education have to be right, but the information should be presented over a period of time and constantly reinforced. Okay, there is a massive difference between taking a 2 to 5 day course, walking away with a trading manual and opening a trading account, as opposed to taking a course, having access to online trading sessions, being part of a trading community forum, and having access to daily market reviews and daily market levels. And all of this will be over an extended period of time. So 95% of retail traders are consistently on the losing side of the Forex market and will generally have their account wiped out within 6 months. And this is because 95% of retail traders are taught the same strategies and techniques for trading the Forex market. And ultimately, this simple fact means that 95% of traders will make the same mistakes. So by now you know that the Forex market is the largest business in the world. Okay, so previously you learned that the Forex market is the largest business in the world. But what's important to understand is that without a doubt it is one of the most misunderstood businesses in the world. Okay, so although we have many participants, both institutional and retail, who actively trade the Forex market, the largest business in the world on a daily basis, many of them misunderstand the business altogether. Okay, so if you ask the average trader what a bull or a bear market is, they will generally give you a technical outline on how to identify a trend. Okay, so if you ask the average trader what a bull or a bear market is, they will generally give you a technical outline on how to identify a trend. And this would include things such as higher highs and higher lows, or many people will simply say there are more buyers than sellers, or vice versa. And you can test this for yourself. If you know a trader or traders, just ask them what a bull or a bear market is, and just listen to the answers that you get. 9 times out of 10 you will get a technical outline, and this will become important later. So if you were to ask when a trend may end or reverse, they would generally refer to a reactive indicator with overbought or oversold zones, or point to levels of support or resistance on the charts. Okay, and again, this is something that you can go out and check for yourself. Pull up a chart, and just yourself, for somebody who may have traded for some time, put up a chart and just have a look at the tools or the images that you will use on the screen to determine when a trend may end or reverse, and just take note of the tools you may be using. Okay, now the importance of the last 2 statements is to highlight that the world of retail trading and trading education revolves around the study of effect. Okay, and I just want you to think about that for a minute. The world of retail trading and trading education revolves around the study of effect, and this is a fundamental mistake. The movement of prices, the development of patterns, and the oscillating of indicators are all visual representations of effects of a greater and underlying cause, which is smart money. Okay, so every time you have seen price movements within the Forex market, every time you have seen a pattern develop, whether this be a flag pattern, a ascending or descending triangle, or any of the common patterns. Anytime you've seen the oscillation of a trading indicator, these are all visual representations of effects. Okay, so the importance and the breakthrough in successfully trading the Forex market is understanding the cause of these effects, and the cause of these effects are the banks, or what we refer to as smart money. So when I refer to retail traders and retail education dealing with the effects of the market, what exactly am I talking about? Well, retail trading and retail education deals with the what and how of the financial markets. Okay, so their general approach to trading and also learning is dealing with the what and also the hows. So for example, when you attend a course on FX, stocks or commodities, one of the first things you're going to learn is what is a bull trend. Okay, and then you're going to learn how to identify a bull or a bear trend. And then they're going to bring a myriad of fancy indicators, and you're going to learn what is an indicator. And then second to that, you're going to learn how to interpret an indicator. Okay, then on to chart patterns. So what is a chart pattern? And then you're going to learn how to trade the many chart patterns that technical traders trade. And then you're going to go into what is support and resistance and how to trade support and resistance. So the whats and the hows of the financial market is the underlying philosophy behind retail trading and also retail education. Now, in professional trading and education, they deal with the why. Okay, so the hows and the whats are second to the why. Okay, so when dealing with professional education, you're going to be taught why do we have a bull and a bear trend. Okay, why do we have support and resistance? Why do we have chart patterns? Why does the market consolidate? Now, this difference in thinking and this difference in approach in terms of your hows and whats and your whys is the only reason that 95% of traders will continue to be on the losing side of the market. Because as stated before, the Forex market may be the biggest business in the world, but because 95% of retail traders do not ask or are taught about the whys of the industry, Forex remains the most misunderstood business in the world. Now, the difference in these two approaches, so the difference between the professional approach that deals with the why and understanding the fundamental nature of the industry, as opposed to the retail approach which deals with the hows and the whys, the difference between these two levels of understanding is quickly highlighted when the perceived effect of a market doesn't match a cause. Okay, so when the perceived effect of a market doesn't match a cause, you would generally find that retail traders become confused very quickly. Now, examples of this will be price falling after good economic news releases, or prices rising on bad economic news releases. So, for example, we're waiting for the non-farm payroll to come out, and we're ready to put on a position, and the position comes out better than expected, so more jobs have been created than the economist and the market had expected, but yet price falls. On the flip side, we have a lower than expected news release, where we have less jobs than was forecast by the market, but we see prices rise. Now, the level of understanding in terms of how the banks and how the major institutions work within the industry will give you an understanding as to why many times the effect doesn't match a cause. Okay, so the cause being good news, the effect being negative price reaction. Okay, on the flip side, the cause being bad news, the effect being positive price reaction. They don't match, and this is something that quickly confuses retail traders, especially if you have a position on. Okay, more examples of which are unexplained extreme price moves in the market. Many times the market will be moving steadily up or steadily down, or it could even be moving sideways or in consolidation, and all of a sudden, boom, you get a massive extreme price movement. And this is in a time where there are no news events, in times where the market is relatively quiet and steady, but for some reason or another we see extreme unexplained price movements. Now, smart money are behind these moves. The banks, the hedge funds, the major institutions are behind these moves, and the understanding as to why these moves occur and where they occur is the key to understanding not only their business plan but how they meet their objectives. Okay, so again, for a retail trader, asking the how and the what of an extreme price bar is all well and good, but if you have an understanding as to why they occur, you're in a better position to profit from the financial markets. Okay, more examples of which are a bear market in times of economic booms, or bull markets in times of recessions. Okay, so throughout the last recessions, we've seen many times that we've had major bull markets. Okay, or in times of economic booms, we've seen major bear markets. Now, again, the cause and the effect don't match. Okay, in terms of an economic boom, we have a positive cause. We would expect a positive effect. Okay, and in reverse, where we see a cause of a recession, we would expect a negative effect, but we see a positive response. So again, the cause and the effect do not match, and this again is where retail traders become very confused, because they would tend to take the wrong side of the market and lose money. Now, this mismatch that occurs between cause and effect whilst analysing the financial markets is not just reserved to fundamental analysis. Now, as a retail trader, 9 times out of 10, you're going to be sitting in front of screens with your charts, and you're going to be using a myriad of tools to analyse the financial market and try and make a profit. Now, many times the tools that you are using can be your worst enemy. Okay, so the banks, the institutions, all the big players in the Forex market are aware that retail traders are heavily reliant on indicators. Okay, so for this very fact, it is useful for them to know how to manipulate the tools such as trading oscillators, so that they can induce traders into buying or selling into a market that will suit their agenda. Okay, so if a bank wants to buy, and this is something we're going to go into a lot of detail in our next sections, but if a bank wants to buy, then they're going to need sellers, and if a bank wants to sell, they're going to need buyers. Okay, so trading indicators are very often manipulated, and generally what you will see is markets falling when indicators are in their oversold zone, or rising when they are in their overbought zone. Okay, and again, because many traders will blindly follow these oscillators, and as soon as the market, or as soon as the indicator enters into an overbought zone, their bias will be to sell, and vice versa. When the indicator moves into the oversold zone, their bias generally automatically looks towards the buy side. Now, this is done by design. Okay, most indicators, if you know how to use them properly, can remain within a oversold or overbought zone for an extended period of time. But many retail traders will blindly follow these indicators, and there are so many of them that if one fails, you'll generally find that the trader will move on to another, or in some extremes they will have 3 or even 4 of these indicators on the screen all at once. Okay, because you can have 2 indicators, both being oscillators, both with overbought and oversold zones, and one can be in the overbought zone and one can be in the oversold zone. They can give you conflicting information, and this only leads to confuse the trader further. So the mismatch between cause and effect will very often take place in the tools that you use to apply to charts. And this especially highlights the difference in the level of understanding between professional education that deals with the whys and retail education that deals with the hows and the whats, because you can understand what an indicator is, you can understand what an oscillator is, you can understand how to interpret the indicator or the oscillator. So in this example, you can interpret that when the indicator reaches the oversold zone, that the momentum of the market should turn to the upside and we'll be looking to buy. And you can be taught how to interpret that when the indicator reaches the overbought zone, that the momentum of the market should turn and our bias will be to sell. But what happens when the effect doesn't match the perceived cause? Okay, so the perceived cause of the market turning by most retail traders is because the indicator has reached an oversold zone or an overbought zone. Now, this is very often reinforced when they see it happen right in front of them. Okay, so once this happens a couple of times, they begin to believe that the cause of the change in price action, the change in momentum of a market, the change in trend of a market is actually because of the trading oscillator, because it's reached an overbought and an oversold zone. Okay, now without understanding the true underlying reason as to the change in momentum of the market or the trend direction, and understanding the fact that the movement into the oversold zone or the overbought zone of an indicator is a result of a cause which is unseen, and that is the banks. Okay, so understanding the why is always going to outweigh the hows and what, because you'll have a underlying foundation as to what moves price, what moves trading indicators, and ultimately what moves the Forex market as a whole. Now, this next point is something that most retail traders at some point or another would have experienced, and that is taking a position and constantly getting stopped out by just a few pips, only to see the market move in a direction that they were originally in. Now, this is something that I can talk about from personal experience, also through my time in the city where I executed thousands of trades for both retail and institutional clients. And many times a client would put a position on, and within 3 to 4 minutes that position would be taken out. Now, there is a reason for this, and if you're a retail trader who is currently going through this, after you have completed this course, you will have a full understanding as to why this occurs, and you will have a full understanding as to how to avoid it happening again. So this is something that causes a lot of confusion for retail traders, and is a large part of the reason as to why most retail accounts are wiped out within 6 months. And the taking of a position after you have done all of your analysis, you've looked at your charts, you've hesitated 3 or 4 times, and then you finally click that mouse and you get into the position, only to see the position quickly taken out by only a few pips, and then continue in the direction that you were originally in. And this is done by design. This is a great part of Smart Money's business plan, and it's done because the liquidity that retail traders create through hoarding orders at certain points around price is what they are after, and they take full advantage of this fact because they can see where these positions are. Okay, so the banks and the major players in the Forex industry can see where the orders of retail traders are, and then they can exploit this fact for liquidity purposes to meet the orders that they have on their books. Okay, so these scenarios will continue to confuse retail traders who have been trading for many years, let alone those who are new to the market. So you have traders who have been trading for 3 to 8 years plus, who continue to be confused by the scenarios which we have discussed. So as a new trader and as an experienced trader, receiving the right education and having the right understanding as to the powers that move the Forex market is essential to your long-term success. So without understanding that the true cause behind the price movements and fluctuations in the FX markets are the banks, you continue to be in that 95% of losing traders. Okay, so retail traders are trying to apply strategies and rules to a market they have no understanding or control over. Okay, so retail education is full of rules, it's full of guidelines and strategies and various techniques. It has fancy indicators, we have EAs, we have so-called gurus, all of which are attempting to apply their own strategies, their own techniques and their own rules to a market that many of which have no understanding of, but also they have no control over. Okay, so just thinking about that for a second, wouldn't it make sense to have an understanding as to the strategies, the techniques and the rules that the major players of the Forex market apply to FX? Okay, so if you have an understanding as to the strategies and techniques they apply, then you can adapt your trading style to meet with theirs. Okay, and that is the point of this course, and that is the ability that you will have once you have completed the course. So the strategies and the various techniques of retail traders and retail trading education is a futile attempt at applying rules to a market that not only they have little understanding of, but to a market that they have no control over. Okay, so when it comes to the retail industry and the companies that offer free Forex education, why are they so generous? Okay, so why do Forex brokers, spread betting companies and banks offer you so much free trading education? So if you look online and you go to the majority of brokers or spread betting companies or banks, they will have offers on free seminars. Many of them will cover webinars where they will talk about different strategies or different techniques that they use to apply to the financial markets. They generally have ebooks that you can download, and you can even go on free trading courses, sometimes physically or online. Okay, now many of them will also give you free access to trading platforms such as MT4. Now, these platforms are not cheap. Not only to those who develop their own trading platforms, such as many of these spread betting houses and many of the broking firms, these platforms cost millions to create. Okay, they cost literally millions to create. And even licensing something such as MT4 can cost hundreds of thousands of pounds. And these are generally given out free to clients once you sign up for their services. Now, with the trading platforms and all the education that is on offer, why has this been given away for free? These are companies whose sole purpose is to accumulate as much profit as they can from the retail sector, but yet they will invest millions of pounds and also time in giving away free services. Now, just ask yourself why. Okay, now the reason for this is they have to keep you trading. Now, they know that 95% of retail traders will lose their money, and this 95% will remain constant regardless of the education that the retail trader receives and regardless of how long they have been trading for. So keeping you trading is their ultimate goal. By providing free education and by constantly tweaking and updating seminars, when traders who have been failing for some time continue to fail, they can continue to re-educate themselves for free. Okay, new traders who are coming to the market, they will then be enticed with all the free and all the generous offerings of seminars and webinars and free trading platforms. And just like with the traders who have been trading for some time, will fall into the same trap. So what is the purpose of this trap? Why is it their ultimate goal to keep you trading? Now, their ultimate goal to keep you trading is because all financial market professionals and all financial market institutions have a business plan, and you are a part of their business plan. Okay, so the major banks, the hedge funds, the big players that interact and move the Forex market on a day-to-day basis, the smaller companies and the smaller institutions that offer services in relation to trading the Forex market or educating retail traders in the Forex market, all follow a business plan in some way or form, and you are a great part of their business plan. So without you, they have no business plan. Okay, you are the oil that keeps the machine running. Okay, so with all institutions in the Forex industry, profit forecasts or projections are made on the amount of retail traders that they have on their books. Okay, so a brokerage, a spread betting company, banks who offer services in relation to Forex and deal with retail traders can project forecasts or make projections on profits just by the amount of retail traders that they have on their books. Okay, so if you understand this simple fact, then it's very simple to understand that it's in a broker's best interest to keep you trading as much as possible. Okay, so though they are generous and there is a genuine service that they are trying to offer, the education which is being received by the majority of retail traders is no good. Okay, and is it known by most of the companies and institutions? I would say yes, to a point. But what's the alternative? The alternative is you teach everybody the underlying influences that move the Forex market, and clients of these institutions and companies will become wise and become better traders, and ultimately the profit margins of these companies would fall, and that is not only counterproductive, but is not sustainable for any business that wants to achieve long-term success. So simply understand that the long-term objective of the major players and the smaller companies which offer financial services related to Forex, that their ultimate objective is to keep you trading. So in terms of the education that is offered to the average retail trader, we've looked at support and resistance throughout this course. We've looked at indicators, we've looked at moving averages, moving average crossovers, breakouts. We've taken a look at chart patterns such as triangles, wedges, flags, and we've also looked at things such as pivot points. Now, all retail education is based on trading the charts and price at face value. Okay, so the subjects that you went through earlier, as we've already established, are the hows and the whats. And the hows and the whats deal with trading the chart at face value. So you are taught to trade the effect, okay, of the underlying cause. So for example, every time you see a chart pattern, so you may see a wedge. Now you may see a wedge in the euro dollar, you may see a wedge on the euro sterling, say 30-minute chart. You may then be flicking through your charts and see a wedge on the CAD dollar. And you could go through many currency pairs and see this same pattern. Now, how can this be? What is it that is occurring within price action that this seemingly random geometric pattern appears to form within the price action on charts? Okay, why? We can understand how to identify it, we can even understand how to trade it, but if we don't understand why they appear and how they are used by the large players within the Forex market, We'll only ever be trading the effect or what we see on the charts. Okay, and the same can be said for support and resistance. By now we can easily identify what a horizontal support and resistance line looks like, or a vertical trend line looks like. We understand how we can trade these lines, but do we have an understanding as to why they appear, and also why they are created by smart money and the large institutions that move the Forex market? Okay, so up until now you have learnt the effects, you have learnt what you see on the charts, but in this part of the course we're going to go through the underlying foundation as to why they appear and why they are created and utilized by smart money. So again, all retail education is based on trading the charts and price at face value. You are taught to trade what you see, the effect, without knowledge or understanding of what it is you are seeing, which is the underlying cause, which by now you know are the banks. So what are they not teaching you? They're not teaching you that the movement and creation of the prices, the patterns, and the movement of the indicators on FX charts all reflect and move according to a well-organized, sustainable, and repeatable smart money business plan. Okay, so the movement and creation of the prices, patterns, and indicators on FX charts all reflect and move according to a well-organized, sustainable, and repeatable smart money business plan. And this is what we're going to start to get into in our next sections, and we're going to look at many examples of not only the smart money schedule, but we're going to look at the identification of manipulation and the process behind the downfall of retail traders, which ultimately is the smart money business plan. So let's look at some facts that we've established so far. We've established that 95% of retail traders are taught the same trading strategies and techniques. We've also learned that 95% of retail traders are on the losing side of the Forex market. And again, it's not hard to see that the two go hand in hand. Poor education results in poor trading. Now, earlier on in the course, we established that the Forex market daily turnover is $4 trillion a day. Okay, so by far, it's the biggest business in the world, though the most misunderstood. And the daily turnover is $4 trillion a day. And then we've learned that 10 banks control around 80% of the FX market's daily turnover, which equates to around $3.2 trillion per day. And the 10 banks that control this massive 80% we refer to as smart money. Okay, so if we can't beat smart money, then we will have to join them. So we know that banks control the Forex market, and we know that they will want to take advantage of the $4 trillion of daily turnover each day. Now, professionals and institutions in all industries create and follow sustainable and repeatable business plans to sustain growth and maximize profits. Now, that's just common sense. In all industries, any business which wants long-term success and sustainability must create and follow a sustainable and repeatable business plan. Okay, if your ultimate aim is to grow and maximize your profits, you have to establish a sustainable and repeatable business plans. Okay, so the professionals trading in the Forex market are no different. Okay, this is the biggest business in the world. So the professionals trading in the Forex market are no different, and they follow a simple and repeatable business plan, and they execute this strategy every single day. And as established before, you are a part of this business plan. So this business plan is reflected in the daily movement of FX prices and can be identified and utilized by retail traders. So the key to becoming a successful trader is to stop trying to apply the strategies, rules and plans of the losing 95%. Your ultimate goal is to understand and identify the strategies of the true cause and effect of the FX markets, the banks. Okay, so the business plan of the big institutions or the large institutions that interact with the FX market on a daily basis not only can be seen in the daily movement of the FX prices, but is simple and repeatable. Okay, now if you think about that, it makes sense, because having a complex strategy or complex techniques that you apply to the FX markets, like many retail traders do, creates many problems for you in terms of execution, and also can oftentimes be your undoing, because one thing about the markets is it should be kept as simple as possible. Okay, the company name is a testament to the philosophy that we take in terms of our trading approach, which is to trade simple and to trade smart. So the smart money business plan, although simple, has to be enough to counteract all of the different strategies and the different rules, the different schools of thought, and the different add-ons and oscillators and tools of the retail world. Okay, so they had to develop a strategy which could counteract all of the different techniques that retail traders attempt to apply to the FX markets, and it has to be repeatable.